All right. Good morning, everybody. I give a reminder that I probably don't give enough. These morning briefings are designed to help you learn how to put together your own morning plan. I don't do these to give you my plan. It's just a byproduct, right? You end up with my plan because I need to perform it live over and over, again and again, to help these things sink into your mind, the steps that we take every day. So we perform these steps and you end up with my point of view, my plan for the day, but that's not the goal, right? So the goal is to teach you how to do this for yourself so that you don't need to go and find somebody else's plan, right? I tried doing this with a video a long time ago. I made a video saying this is the steps that you should take. I listed everything out in order. If you wanted to find that video, it's poorly titled. Uh, you would go to YouTube, search bullish bears trend day checklist. And if you were to find that video, I listed out all of the things that we would want to look at and how you can put together this plan. It seemed the market was a little confused yesterday. It went from, hey, maybe we're going to turn bullish to, nah, maybe we're not going to turn bullish after all. Looking at the market wrap, it seems that there was just enough language in there from a hawkish Fed and a dovish Fed that the market pretty much had to sit back and say, I don't have enough information here. Are we supposed to be bullish or bearish? So they kicked it over to the nerds. The nerds crunched the numbers and said, yeah, no, you know, that looks kind of bearish. And so then we flipped over and headed back down. It really comes down to this September right now. I mean, there's a couple of things going on here. Everybody's looking for the Fed pivot. The Fed pivot is supposed to be like Q1 2023. Well, the Fed is giving some signals that it may be entrenched and it might have to be second quarter or third quarter of 2023 before they start to pivot. And even by quote starting to pivot, that means they're going to use that stupid language again where they say we're thinking about having a talk about maybe not raising rates anymore, right? That kind of stupid language will come back again. And then it won't be we're thinking about having the talk. It'll be, oh, well, now we're thinking about having the talk. And then it'll be, we're going to have the talk, right? So you see how the progression will reduce more and more until, and they think that this kind of parsing the language is cleaner or clearer or in some ways signals to the rest of us what it is that they're thinking about. To me, it just sounds a little stupid, but you know, thinking about having the talk, just even having to say that sounds stupid. This Fed fund tool right now can offer more guidance on what the market is working on than just about anything else. Because right now, this is what the market is focused on. When are we going to pivot? What kind of rate hike are we going to get in September? Because obviously, they're not going to not do a rate hike, right? There's going to be a hike. The argument or the discussion now is, will it be 50 or will it be 75? And that's the only two choices right now for September. 50 basis point rate hike, 75 basis point rate hike. Now I showed this screen yesterday, right? And it was closer to closer to 50-50. Now we're back into that 60-40 camp, right? 60% probability that we get a 50% or 50 basis point rate hike. This is part of the reason the market really didn't move and explode higher yesterday. When CPI came out, that pretty much gave the market the information that it needed to start betting on a 50 basis point rate hike. And we spiked up because they started to unwind a 75 basis point rate hike. That's where that spike came from after CPI. We're in the same spot. The minutes came out, everybody parsed through it and decided, yep, no, we're probably going to get a 50. Well, that's where we was after CPI. So the spike that we got after the minutes came out was unwarranted, and we just unwound that spike as we came into the end of the day. So we're right back where we were. We're not bullish based on the minutes. We're not bearish based on the minutes, but everybody's going to continue to be parsing data, looking for what we're going to do with September. Now, March, on the other hand, is where they're starting to, it's where they were thinking about the pivot. Would the Fed begin to signal a pivot in that the start of second quarter, basically? Would they begin to unwind? And this is worth keeping your eye on, right? The September one, obviously, since it's the closest one, if they begin to reprice a 75 basis point rate hike, the market is going to head back down to where we were when CPI came out. Otherwise, any moves in the market that we're going to be seeing between now and September is all going to be the market looking at anything that the Fed says on TV. If they come out and they're chipping their teeth and having meetings and showing up on the news cycle, if they go out there and they start to imply that that they're going to remain hawkish longer, or that that the data is causing them to need to give us a 75 basis point in September, then we're going to see the market start to adjust or wobble to that. Every bit of data right now is going to be scrutinized heavily, and any company or any firm that comes out and has to downgrade forward earnings, or in some way mentions that inflation is causing them to lose business, more layoffs, any big firm that dumps a bunch of people out, all of that is going to be taken into the extreme. Now, it's important to remember that we do have an election coming up, right? We got the midterms and all of that, and there's a seasonality to the market. You got to kind of step back and look at that in the bigger picture, right? It's, on a day-to-day basis, it's not like we're going to go in and take a trade because, oh, well, it's September and September is supposed to be choppy, or sell in May, or whatever the goofy little phrases are. But it does kind of give us some idea of what kind of volumes and what kind of volatility we typically would see, right? And whether it's a first-term president or a second-term president, whether it's the 2-year cycle or the 4-year cycle, that seasonality does exist. The amount of flow and the strength of the flow since mid-July has been absolutely extreme, and it's not done yet. So until that starts to unwind, we're still going to be looking for any upside move, especially now that the minutes came out and the market didn't make any serious adjustment, right? So 4,400, maybe 44 half. We're definitely not going back to the highs, and seeing as how the Fed has already signaled that they're going to continue to raise rates until they see very clear signs that all of this is beginning to actually work. inflation is abating, they're going to just keep on doing it. So we're going to very likely retest some lows. But when you flip the coin and say, well, what's more likely? We go to 4,400 or we go to 4,100 first? Which one are we likely to do first? Yeah, we're likely to go to 44 before we go to 41. But both are on deck by the end of the year. Just kind of keep that in mind, right? As you can see, looking at the market watch, we have a lot of things on deck today, but not a lot of instances. 8:30, 10, 10:30, 11, 11:30, 1. That's it, right? So the lunch today probably won't be one. When we get into 11 o'clock, we're going to start tapping into all of these auctions. There's no 12 o'clock auction today. So after 11:30, between 11:30 and 1 is going to be that tricky spot. Probably won't run a 0 day. It'll really depend on that 30-year tips, right? I don't like to run 0 days in the mornings if we have a lot of econ. And I don't like to do them in the afternoon if we have any late econ, like a 2 o'clock econ. A 1 o'clock economic situation, yeah, we could probably still do a 0 day, but it's really going to depend on that 30-year today. We are still firmly above the weekly pivot point. So there is that in our favor. As long as we're above the weekly pivot, we're considered bullish. We're back above the 4. We're still in surge. That surge is with momentum. The momentum is with the trend, and the bullish strength is still improving. Nothing's changed. Volume's really light this morning compared with, say, yesterday at the same time. We're sitting at around 70, and yesterday we were around 100. But we're more in line with where we were on previous days, right? All in all, I'd say we're a little light this morning. It's a fair assessment, right? We're a little light, but not extremely so. So I wouldn't let the volumes this morning weigh too heavily. It is OPEX. OPEX happens on the third Friday of the month. Tomorrow is the third Friday of the month. So as we usually do every day, we want to focus on the 3 things that the market can do. We can hold the line, stay within yesterday's price action, be a range day, and a base case argument. That really is our argument for today, is that we just remain inside of yesterday's price. We can break to the upside and begin that expansion, and or we can break to the downside and begin unwinding this price action. That is always our argument every day, right? It's the 3 things that this market could do. Well, it wasn't magic. I seen your guys' post about the audio and tried to make some adjustments, and the adjustments worked. We've been having issues with Restream, so it's kind of just you have to nudge it and poke it and hope that it works. I can't wait to get rid of it. I think we're going to be going to something else like OBS Studio or something. So we chased away the gremlins and it works again. Cross our fingers that it continues to work. So with this base case argument, we're not waiting on any more data, right? At least not for this week. So I keep coming back out to the daily chart for a reason. If this is a topping pattern where we start getting into a base like we had back here, you got to remember the indexes, they're mean reverting, and the thing that they do every day again and again and again and again, right? One day, if you're just a new trader and you show up and you look at the market one day, it seems like it's a unique day. It's a day that's never happened before. You've never seen anything like it. Once you start doing this for a while, and especially the indexes, not necessarily like in the equity markets, but sector names, ETFs, indexes, the kind of day that you're looking at is a day that's happened before. They just repeat. They're not unique. So once you start to identify the kind of day that we have, oh, it's crazy bullish, it's crazy bearish, it's a range day, it's a midday reversal, a pop and drop. There's only so many kinds of styles of days that we have, and then they just begin to repeat again. And the main trick is recognizing which one of those days today is, especially before the bell even rings. Some of that insight can come from looking back at previous days. What are we setting up for today? And how does that compare to a previous day that we've had? We've been getting these, I like to kind of think of them as zones. We leg up into a new price zone and we maintain that zone. And then we leg up into a new price zone and we maintain that zone because it's a part of what the market does: expansion, contraction, expansion, contraction. So, what we really want to focus on right now is the current contraction. When is this going to end? And in what direction is it going to end in? Are we going to leg up yet again into a new zone, or are we going to leg back down into a previous zone? But right now, the market seems more worried about going up than down. And, I mean, that's not an unbiased argument. We've made significant progress off of the lows. Everybody that I talk to says they feel like they're owed a down move, and a strong one, a down move like we had back here, right? But the market doesn't owe us anything. We've just been so bearish this year that it's hard to shake it off. Everybody kept talking about bear market rallies and how the bear market rallies get bigger the longer that the bear market goes on, right? And so every new run to the upside that was getting bigger and bigger, and then it would dump and we'd run up to the upside and then it'd dump, kind of has us all looking for the rug pull, saying, oh, I don't want to go long because they're just going to yank the rug out from under my feet and dump it back down on my head again. But everything changed July 15th. It's a completely different market now. So you got to shake off that old mindset. So for the moment right now, we are still looking for an answer to this current range. How are we going to resolve this range? The base case argument for today is that we're going to hold inside of yesterday's price action. And there's absolutely no reason to believe that this is not our strongest, most likely outcome of the day. That we're just going to hold inside of yesterday's range because we really don't have a catalyst today. None of these are fire starters. Now, that doesn't mean that they can't become one, right? We could get some really far outsized report. It could be a big miss. The market starts to price in early, right? They think they've got an idea of where we're going. So if one of these numbers misses the consensus estimate drastically, sure, we could get a big move from that because everybody's going to be off sides. But for the most part, none of these are fire starters. So the argument is going to be very likely we just maintain this range unless some bit of news comes out. Goldman Sachs yesterday threw a firebomb at 10:53 in the morning, 11:53. No, at 10:53 yesterday. They downgraded China's GDP. That took 3/10 off of their yearly GDP estimate of China. And the market immediately responded to that. Like a gut punch, we broke through the low of yesterday and set new lows on the day. So, it didn't take long before the market bidded right back up again. But that's kind of not the point. Any little catalyst like that could be the thing that breaks us higher and continues to run, or breaks us lower and sends us back down into that previous level. So watch the news very closely in the next 2 days because the market is like looking for an excuse. Okay? Like, give me an excuse. I've heard the phrase a catalyst waiting to happen, and it really seems like the market is waiting on a catalyst. And it's going to get bored and it's going to end up making its own catalyst. They'll just decide that, ooh, that's really bad, or ooh, that's really good. And away we go. The ADR half for today is the COG line at 43.11. That is really close to yesterday's high at 43.15. Above that, we have the high from the 16th. That's going to be 43.27, and it ties into one of our retrace levels. So 43.27, and then a full ADR at 43.43. I'd round that up and say 43.45, but either way. So that's our upside argument. Remember that a full ADR, by the way, is not extreme. That would be our norm. We could move that far and the market would just shrug and say, yeah, it was a good day. It wasn't an extreme, crazy bullish day. It would just be, it was a good day. Taking that argument in the other direction, we've got our own Globex low, the low of yesterday, the ADR half at 42.47, the weekly pivot point, 42.25, and then the full ADR of today, 42.15. There's a really big gap down here. And we're going to want to try to find some pivot points within that zone, like benchmarks and milestones and goalposts to aim for. One of them that I would add would be the Globex high of Friday. If we can catch it. So that gives us a pivot, not quite in the middle between the weekly pivot and the ADR half, but reasonably decent. And we've got a 786 retrace in there too. So we've got a couple of pivots now. That 618 retrace wouldn't be a bad one to add since it ties into Monday's low. Not to the tick, but pretty darn close. Cash open of Thursday. It's another one that you could tie in there. And if we come out to a 10-day, 30-minute chart, you can see that we're inside of the profile. Now, remember how far outside of the profile we were yesterday? We were a long ways outside of the profile. So what changed? Did the market run all the way down and land us inside of that profile? No, the profile came up to price. Remember, every new candle we get on the right takes a candle away from the left. The candles all across this chart are where we get our volume. It's like Captain Obvious, right? Thanks, Captain Obvious. We've got that figured out. Well, we had a lot of days down here in this lower zone. When we lost Wednesday's data, it was just enough to finally bring the point of control up to this new level where we've got Monday, Tuesday, and Wednesday up here. That's it. And you can see that it just happened not too long ago. The amount of volume in that lower zone versus the amount of volume where we're at now, they're pretty close, right? So this volume is slowly fading off the more candles we lose off that back end. Right now, we're back inside the box. We're near the highs. When we're at the high of the box, we say price has nowhere to go but down to the bottom of the box. Now, technically, that's not true, but that's what we say, right? When we're at the low, we expect to go to the top of the box. When we're at the top of the box, we expect to go to the bottom of the box. We are very close to or near the point of control. If we break that, we get into a shallow area and we don't start to see any kind of volume support until 4240. Break that, we got another shallow area to nearly 4200. Break that, we got another shallow area down to the value area low, 4150. I don't see that we're going to go to 4150 today, right? That would be a significantly extreme move. It's doable, just not probable, right? We never want to say that price can't do something, just that it's unlikely to do something. We do still have untouched point of controls. There is one, for an example, at 4233. Should make a move down into that level, we're very likely to see a response out of it. You could also carry the value area from yesterday and the value area from Monday. Could carry those forward. Same thing with the value area on the high side between Tuesday and Wednesday. Generally speaking, I personally don't carry those forward, mainly because they almost always line up with a pivot that I'm already using. Say like the high of Tuesday. Well, the high of Tuesday lines up really close with that value area high of Tuesday. All right, so we're looking at energy. There's a really good correlation right now between stocks and bonds. Stocks and bonds, stocks and energy, energy and tech. We kind of went through this yesterday. So this is technology versus energy. Technology is the first word I mentioned. So when the indicator is pointed up, technology is doing good. When the indicator is pointing down, energy is doing good. From the first of the year until early to mid-June, energy was dominant, tech was not. All of that's shifted. We're now moving in the other direction. We want to continue to keep our eye on this. Energy is a big deal. It is large enough by market cap to throw its weight around. We want to keep our eye on it. Some of the biggest movers on a day-to-day basis continues to be energy names. So a pretty strong struggle. That's why we keep getting these pullbacks. And stocks versus bonds. Since stocks, the first word I mentioned, if the indicator is going up, stocks are doing better than bonds are doing. And if we're going down with this indicator, then bonds are doing better than stocks. We're starting to flatten out a little bit. Now we've seen some pretty good sized moves in the last few days. If you look at some of the drastic moves we've seen in gold, Bitcoin, bonds, the dollar, and yet no real outcome out of those, right? Like a hamster on the wheel, running and running and running and putting in all that effort and work, and then getting right back where he started, all that effort and work for nothing. The S&P and the NASDAQ are up this morning around a quarter of a percent. Nice recovery off of the lows. We're very close to breaking out in oil. VIX is continuing to fade down towards that 23. So we want to set a benchmark, a little bit of a level. If we break below 23, we're very likely going to see an expansion in the S&P above yesterday's levels. We get below 22, and we're probably going to expand higher on the week outside of that pivot that we were talking about in the SPX. So with this in mind, we were drawn into the 786 last week. That's the red doji is where we hit it. That was a 786 bounce. On the Friday, we got gravity, pulled us right up to it, and then we broke through it and we squeezed the shorts and exploded beyond it. Then we gravitated to the 200. It drew us to it and drew us to it until we finally rejected off of it. The next point that we want to focus on is that solid red line. That makes more sense when you got the visual. Seven, 8, 6 bounce. We finally broke through it and squeezed the shorts. Made it all the way up to the 200 like gravity. Just kept pulling us to it. So now the next one, that red line. So if we start to break back up, if we get above our own high right now, 4302, put that 200 on your chart on the intraday so you can see that thing in the middle of the day and keep that big red line on there so you'll know when we're going to hit it or that we're moving towards it. Because if we begin moving back towards it like gravity, it's going to draw us to it. The main concern is going to be, are the traders front running it? Because we're all going to expect to get there and then dump. The trick is anybody standing in front of it ready to dump it before everybody else dumps? If you want that on the intraday chart, type in the word daily, and you'll get a daily SMA. Now, when you go into the intraday, you can see that daily 200 and where we hit it. All right, Cisco had earnings this morning. Good size gap up. Right now it's bidding at around 49. So the gap is closed. See this gap from back here? We're above that yellow line this morning. The expectation is that we're going to hold that yellow line, that it's now going to be support. Cisco's been in a really decent base. And if we're going to continue this move up, probably want to focus on the year-to-date VWAP. We're only $1 away from that VWAP, maybe $1.50. We're primed up nice in Tesla. It is above that 200, but that 200 is basically sideways. Now this morning we're bidding at 919. So that gets us above yesterday's open. There's a trade setup here. In the pre-market, you want to see a rally up greater than the open of the previous day, and preferably greater than the previous day. That way, when the bell rings and it tries to fade down, it bounces off of the previous day's high. If not, then the trade for Tesla is going to be that once the bell rings, we rally up and break through the high of yesterday, and that would be an inside day breakout play. The high of yesterday is 928, and we're sitting at 920. We closed at 911. The target for Tesla would be 940 to 944. All right, Netflix. We got that cup without a handle. That was a weekly. Let's go to a daily. So we got our cup, we got our handle. We're now looking for a resolution of this wedge. We're at 242.50. ish. So we're better than where we closed, but we still got that high of yesterday to deal with. $244.25. If we can get above that, then we just want to work on yesterday's pivots, or the day before, 816. So 245, 247. You're looking at a 3% move to get back up to 248.75 ish. Netflix has got an ADR of 3.6, so it's got the legs to make a 3% move today. Now, whether it will or not, looking at that weakness, this has been one of the names that really caught fire. It was one of those beat down names, right? And we've been looking at the beat down names, the names with the greatest amount of shorts, because those shorts are just really getting lit up, right? They're getting squeezed hard. And remember, you can run the command to see the top short names, but think about sectors that are getting squeezed too, like the pot sector and a lot of the tech sector, right? Maybe not necessarily the sexy, glamorous monsters of tech, but still a lot of the tech names. Names like PayPal and Netflix that got severely beat down. JD, Baba, Baidu. Looking at Amazon, we got tangled up in that 200. We didn't resolve it, broke off of it. This morning, we're slightly better than where we closed, but not by much. But we've got a really nice red to green setting up here in Amazon. What I want to see before the open is that we get higher than the previous day's open. That pivot point is a really strong pivot point. If we can get above it, we'll use it for support this morning. Look for a bounce off of it to get an inside day breakout and try focusing on getting back above this sell zone and maybe retesting that 200. Amazon's got an ADR of 2.8 from where we closed. 2.8 would get us close to the 146. So it has the legs to make that kind of move. Google finally made it out of this box. Yesterday it retested the box. This thing really needs to hold. That's a Busby. So we're looking for reciprocation here, back up to retest the 200. Got Adobe here. It didn't quite make that 200. We are significantly away from the 20. Now the 10 week is used more for like our longer term swings. The 10-day for the shorter term swings. Each market has a distance from its 10 that it'll travel before it's traveled too far, too fast. Since each market has its own distance, you got to turn on the indicator and see, well, where does this particular market have a turnaround point? For Adobe, it's around 5% is where we start getting into the extremes and we see Adobe pause and begin working back towards that 10. Well, we're basically flat. We're really close to the 10. So this thing has the legs and the capacity and the potential to make some big moves. I'm sitting here looking at these names, and sector is always what comes to mind. What sector is moving in the pre-market? What industry is moving? What sub-industry is moving? Because that's going to be a lot of where we want to focus our attention. What I'm not seeing this morning is a lot of energy names. So here we're looking at the Dow Jones rather than my own personal watch list, right? Dow Jones is, it's reasonably decent. It's got a good scattering of different names. There is an energy name in there. This energy name, CVX, Chevron, it's down slightly in the pre-market. Other names that are down this morning, Apple, Walgreens, Verizon, IBM, and then we've got a lot that are just flat. Really no input from them at all. A lot of healthcare names, consumer discretionary, a couple financials. We start looking at what's doing good this morning. Of course, we got Cisco because it had earnings, but we've got Caterpillar, Boeing, Johnson and Johnson, Coke. Recognize that those are defensive names. They're not offensive names, right? And that makes sense. So we want to focus on that capital rotation this morning and continue to try to parse out, are we going to see a capital rotation out of the sexy, glamorous tech names and back into more of utilities and real estate and consumer staples, industrials, materials, energy? The three risk on sectors: technology, finance, and consumer discretionary. Really keep your eye on those three this morning. And it's not going to be just the monsters of tech, right? Because we watch the monsters of tech, that's a given. But with market breadth, if the monsters of tech sit out, we can still see technology run, or we could still see finance run, right? So the NY Fang, the KRE, that's tech and finance, provides a lot of insight on what the market's doing, gives us more clues about V bottoms and midday reversals and rallies. It's my day to stream. I'll be in the futures around 9:15. That's what I got for you guys. Be careful. Have a good day, and I'll see y'all tomorrow.